Welcome back to Trading Hour on CNBC TV 18. As promised, we're going to get to a conversation with Titagarh Wagons. They came out with their second quarter numbers. It's the highest ever revenue for the quarter. However, the margins dipped despite a low base. To discuss the quarter gone by, we're joined by Umesh Chaudhary, the Managing Director and Chief Executive Officer. Umesh, great speaking with you after a while. Just wanted to understand, this was a very good quarter on the top line for you. You did 600 crores of revenues, which is, a growth of over 77%, but of course on a lower base. What's the average run rate that you can see in the second half, and what are the demand trends looking like? How's the order book growing?
Yeah, hi, good morning. Always a pleasure to be with you. So, yeah, we're happy with the set of revenue numbers that we've been able to achieve. So, if you really look at the growth trajectory, and if you look at the 3-year kind of period, so 16, 17, 18, we did an average annual revenue of 300 odd crores. The next 3 years, we did an average annual revenue of 1,000 crores. And now we've been able to get to a quarterly revenue of about 600 crores, and we are still not at our peak because we've been able to, as I spoke in the investor call yesterday, we've been able to do just under the 600 wagons a month, about 550 to 600 wagons a month. In the next couple of months or 3 months, we have to get to a run rate of 700 wagons a month. So that would really get to the optimum revenue level. But we are pretty much on track to get there. So I would say that the journey that we had started about 3-4 years ago to ramp up our overall size of operations, we are well on track to achieve that.
Umesh, morning, and thanks so much for joining in. Could you talk a bit about any future metro tenders which are in the offing? I know the Pune metro tender you're executing, it's on track. You could complete it by the end of this fiscal year, Q4 FY23, or if not, Q1 FY24. But any other big metro tenders and details and size?
Sure, there are several metro tenders. We have participated in a few. There are some on the pipeline the tenders have been announced, and there are certain projects which have been announced, so they will be coming up. Then there are some train tenders from the Indian Railways like Vande Bharat. So we are kind of participating and evaluating different options. Our target is to get to a capacity of about 200 to 250 metro car production a year, which I think we should be able to get to within the next 2 to 3 years' time. I believe that the tailwind in the metro space or the passenger train space is quite strong, and we are in a very good position to be able to kind of play in this field because we are the first aluminium coach manufacturer in the country. And apart from that, we are also now setting up the stainless steel coach manufacturing facility because of the Bangalore Metro and CRRC contract that we signed. So with this kind of versatility within us for stainless steel and aluminium, we believe we'll be able to cater to pretty much the entire segment of the market requirement.
Okay, that is on the metros. If you could also take us through the shipbuilding and defense, because that order book is quite small, it's just around 3%. What is the kind of growth that you expect here?
So we did announce that we have acquired a small shipyard on the south side of Howrah Bridge. We were constrained because of the air draft and the water draft in our existing shipyard, and we were only able to take limited kind of vessel orders. Okay. With this new shipyard that we have acquired, we are going to complement both our shipyard capacities. We are developing this business as a future business. So we are not really going full hog on the investment in the new shipyard. We first want to stabilize. So we've been pretty much able to stabilize our freight wagon business. Now, the second step, we are trying to kind of balance out the capex to be able to stabilize the metro and the passenger train and the propulsion business. And over the next couple of years, then we will go full throttle on the shipbuilding and the bridges and the defense. So we call that business vertical as SBD, shipbuilding, bridges and defense. We do the modular steel bridges also in that vertical. So that's how we are kind of spanning out the 3 verticals and the growth plans across the 3 verticals in the next years.
Okay, you said that there are 200 to 250 metro car production that you're looking at a year. That's your target. What would this mean in terms of a quarterly revenue for you? You're sitting at 600 crores now. How much, could it be much better than that? What's the run rate?
Sure. So if you look at the current revenue, majority of it is coming from the freight wagons. So a metro car on an average costs about 9 to 10 crores. So when we are able to achieve the peak revenue on the metro segment, 200 cars would give us a 2,000 crore revenue only on the metro segment, which today is at a much lower base. So if you really look at the margins also that we are getting in the transit and propulsion because of the under absorption of the fixed costs on account of not optimizing the revenue numbers, we are not being able to get the real potential of the EBITDA margins on the metro segment. So if we really look at the graph, the freight wagon segment is close to its optimum. The passenger train business, the metro and the propulsion business is just kind of taking off. And I believe in the next couple of years, it should get to the optimum level. And then we will kind of get the SBD on the runway as well.
What will this mean in terms of margins? Because as you get to optimum production, it will aid operating leverage. Your current margins are 8.8%, the way we calculate it in the current quarter. Could these margins improve? What's the range that you're looking at?
The current quarter EBITDA margins are slightly higher. They are at about 10-11% on a blended basis. But if you include the other income, because as I can see from the screen, you've taken the revenue without the other income. But be that as it may, on a blended basis, the guidance that we have always given is that we should be at about 8 to 10%. Our business is one that gives us about 8 to 10% of EBITDA margins. And that would be the guidance that I would like to give to the market, to the investors, because that we believe is a sustainable margins. Having said that, on quarter-to-quarter basis, the margins can vary. Most of our contracts are with price variation clauses, so the kind of movement in wholesale price index gets affected in our revenue number, but on the next quarter, but it kind of the cost comes into the current quarter. So on a quarter-by-quarter basis, the margin percentages can change, but on a blended basis over a period of time, 8 to 10% is a reasonable EBITDA margin that we should target.
All right, got that. 8 to 10% is what you can see in terms of sustainable margins. Umesh, thanks a lot for joining us. We're going to leave it on that note today. With that, it's time for a short break on the show. But when we come back, there's lots more market action, so stay tuned.